What's up, everybody? So, question of the day. Should I pull out a home equity line of credit or should I just refinance and do a cash out first? I get that question a lot, people that want to tap into their equity, and it really comes down to two things. One, what are the current terms of your existing loan if you already have a loan in place? And number two, what are you going to use the money for? There's a fine line between good debt and bad debt. So one of the first questions I ask my clients is, what is the purpose of the funds? If you're looking at pulling money out to go buy a boat, to go down to Lake Mead, probably not a great idea to tap into your equity in your home. But if you're looking at consolidating debt, paying off an emergency medical bill, or doing home improvements, or even transferring equity, moving money from one house and wanting to purchase an investment property, I call that a transfer of equity. If you were going to pull out $50,000 of equity in your current residence to put down on an investment property so that you can acquire more real estate, you're essentially transferring equity from one property to another and using the power of leverage. So first off, what are you using the money for? And number two is, what are the terms of your existing loan? Interest rates are obviously on the rise. A lot of people that have gotten loans in the last couple years have rates in the threes. So it may not be a great idea to cash out, do a first loan, if you've already got a really good interest rate, because you're going to be subject to current market rates. And now you're going to have to pay a higher interest rate on the entire loan. So if you owe $200,000 and you pull out $50,000, now your new loan's $250,000, you're going to pay interest, a higher interest rate on the entire $250,000. However, if you can keep your rate similar or lower your interest rate, it may make more sense to just do a cash out first, so you have one fixed payment. It is the lowest risk type of loan. The other option is to do a home equity line of credit. You've also heard the term HELOC, and that enables you to leave your first loan in place and just pull out a second. There's more risk associated with the HELOC, but if you've already got a really good first loan, I advise my clients to just get a HELOC. A couple disadvantages of the HELOC are, generally it's tied to prime, the prime interest rate. So the interest rate is adjustable. It's also interest only, so there's more risk with it fluctuating. But if it's such a small percentage of the overall loan amount, your blended rate ends up being lower than if you were to do a cash out refinance. With the HELOC, it's interest only. Generally, it's a 10-year draw period where you pay interest only, which means you're never paying that balance down unless you pay extra for the first 10 years. Then generally there's a 15-year repayment term where it goes to amortization, and now they require you to start paying the loan down. So what I like about the home equity line of credit is it's very similar to a credit card. I could pull out a $50,000 line of credit on my house and don't pay interest on it until I utilize the money. So you can leave it at a zero balance, just like a credit card. If you have a credit card at a zero balance, you don't pay any interest on it. Same with the HELOC. It allows you to tap into your equity, and you can utilize those funds when you need them. So let's say I have a ton of equity in my house. You can generally go to 80% loan to value with a cash out refinance and a HELOC. Some of the HELOCs, they'll allow you to go to 90, even 100%, but the interest rates are much higher. But let's just use 80% as an example. Let's say your house is worth $300,000 and you owe $200,000 currently on your first loan. If you take 80% of $300,000, that's a total loan amount allowed of $240,000. If you already owe $200,000 on your first, that means you can pull out about $40,000 on your home equity line of credit. What I tell a lot of my clients to do is borrow the money before you need the money, not when you're desperate to get the money. So borrow the $40,000, get the HELOC set up so that it's a zero balance. You don't pay interest on it, but if an opportunity presents itself, let's say you get an opportunity to buy an investment property and you need to tap into some quick cash for a down payment. Now you can draw on that HELOC to put down on your investment property. So Home equity line of credit is great, gives you that flexibility to draw on it. You can pay the loan down. You can, just like a credit card, you can pay it off. You can keep the home equity line of credit open for future draws. So again, what are you using the money for? And number two, what are the current terms of your loan? So both of these options are great options. Will allow you to tap into the equity in your house and turn equity into cash, and help you achieve your long-term goals, consolidate debt, and just help achieve a better financial situation. So hope this helps. Thanks for watching. Take care.